Happy Friday. It is January 16th, 2026.
It is.
And if you're keeping an eye on the markets or even just your own portfolio, you know exactly what time of year it is. It's earnings season.
Oh, the floodgates are open. And this morning, we got something hot off the press.
We did. We have fresh documents on the desk from South Indian Bank.
Literally just a few hours ago, their investor presentation for Q3 of the 2025-26 financial year, plus the official letters to the exchanges.
I have to admit, I opened this file with a very specific, maybe even a preconceived notion. When I hear South Indian Bank, I think of a certain kind of institution, founded in 1929.
Pre-independence history. It's a legacy bank, absolutely.
Right. I'm picturing, heavy wooden desks, maybe ledgers, a slower pace.
A very traditional feel.
Exactly.
Yeah.
But then I start scrolling through these slides, and I'm seeing terms that feel completely out of place for a 97-year-old bank.
Oh, I know what you're going to say.
I see next-gen banking, I see tech-enabled renewals, and my personal favorite, which we absolutely have to get into, same-store sales.
That one jumped right off the page, didn't it?
It sounds like I'm reading a report for a coffee chain or something.
Or a fashion retailer, not a
Yeah.
bank.
Right. And that clash,
Yeah.
that cognitive dissonance between the old world heritage and this very new world terminology.
Yeah.
That's really the story here, isn't it?
It is the core narrative. Look, this isn't just a routine update. We are watching a bank in the middle of a massive, and I think very calculated, identity shift.
Okay.
A huge pivot from being a traditional corporate lender to becoming, in their words, a retail and MSME powerhouse.
And they have that tagline, where your growth meets our vision, which, is nice marketing speak.
It is.
But our job today is to see if the math actually backs that up, because it's one thing to say you're transforming, it's another to actually pull it off without, breaking the bank.
Pun intended. It's a high wire act. You've got to change the engine while the plane is still flying.
So let's pop the hood. Before we get into all the strategy and this fancy retail metrics, we just need a basic health check. Is South Indian Bank actually making money right now?
The short answer is yes, and the engine is running a bit hotter than it was last year.
Okay.
If we look at the bottom line, profit after tax, or PATI, it came in at 374 crore rupees for the quarter.
374 crore. And just for context, where were they a year ago?
In the same quarter last year, they were at 342 crore.
So a decent jump.
A very decent jump. Solid, steady increase. The arrow's definitely pointing up.
That's good. But I know you. You don't get excited about raw numbers. You care about efficiency, the ratios.
I do. Because a raw profit number doesn't tell you how hard that money is working for you. For that, you have to look at return on equity, or ROE.
So if I gave the bank 100 rupees as a shareholder, how much are they making for me?
That's the essence of it, yes. And right now, South Indian Bank's ROE is sitting at 13.93%.
Almost 14%. For listeners who aren't glued to a terminal all day, where does that sit on the spectrum? Is that okay, good, or great?
In today's banking world, that's a very robust figure.
Okay.
When you start getting into that 14-15% range, it tells you management is deploying capital very efficiently. They're putting it to work. And that's backed up by their return on assets, ROA, which is at 1.12%.
I've always heard that crossing that 1% mark on ROA is a kind of gold standard for a stable bank.
It is. It means for every 100 rupees of assets they hold, loans, cash, whatever, they're squeezing out over 1 rupee of pure profit. It sounds small, but on their balance sheet, it's significant.
Speaking of size, let's talk volume, because the pile is getting bigger too.
It is. Deposits are up to over 118,211 crore. And gross advances, that's just bank speak for loans they've given out, have hit 96,764 crore.
We're getting very close to that psychological 1 lakh crore mark on the loan book.
We are, but for me, the so what here isn't just that the numbers are bigger. Anyone can grow a loan book by taking on more risk. What's impressive is they're scaling up while also improving their profitability metrics. That is hard. Usually when you pivot this hard, earnings get volatile. This feels disciplined.
Okay, so the car's running smooth. It's going fast. Now let's see where it's driving. This brings us to that great pivot we talked about.
This is the critical change.
I'm looking at this slide where your growth meets our vision, and the breakdown of who they're lending to is it's fascinating. Historically, banks like this loved corporate loans.
Oh, of course. It's efficient.
Right. One big company, one 500 crore loan, one stack of paperwork. Easy.
Efficient but lumpy. And very risky.
And South Indian Bank seems to be saying, No more.
No, not no more, but they are definitely rebalancing the scales. If you look at the split now, corporate loans are only 40% of their total loan book.
Only 40, which means the other 60% is everything else.
Personal loans, agriculture, business loans, they've completely flipped the script. They are, for all intents and purposes, a retail-first bank now.
And the speed of this shift is just wild. I mean, I'm looking at disbursement momentum, the new money going out the door. Year over year, retail loan disbursements shot up by 60%. 60.
That does include gold loans, which is a big category, but yes, 60% is aggressive.
And MSME loans up by 45%.
And this brings us to that lovely analyst term, granularity.
Let's unpack that, because it sounds like jargon, but it's so important here. Why is granularity a good thing? Managing 10,000 small loans sounds like a nightmare compared to 10 big ones.
It is an operational challenge, which is what makes their execution so impressive. But think about the risk. If your whole strategy is lending 1,000 crore to one giant steel company.
And that company gets into trouble.
Exactly. Global steel prices crash, or there's a scandal. That company defaults, and your bank takes a catastrophic hit. One bad decision can wipe out a year's worth of profit.
But if you lend that same 1,000 crore to 10,000 different businesses,
a bakery owner in Kerala, a truck driver in Tamil Nadu, a family buying a home in Mumbai, they don't all go broke on the same Tuesday.
you've diversified the risk.
You've woven a safety net in real time. That 45% growth in MSME isn't just growth, it's de-risking the entire bank.
Okay, let's double-click on that MSME growth. You don't just accidentally grow that book by 45%. You have to change how you work.
You have to remove friction. The presentation is actually quite specific about their strategic initiatives. They realized you can't serve a modern business with 1929 processes.
One thing that caught my eye was this GST Power product. What is that?
So GST data, goods and services tax data, is a goldmine. It's the truth serum for how much business a company is actually doing.
Right.
They revamped this product. The maximum loan you could get was 2 crore. They've more than doubled it to 5 crore.
That feels like a very strategic number.
It is. 2 crore is great for a small shop. But if you're a mid-sized manufacturer trying to expand, 2 crore doesn't cut it. By going up to 5, they've opened the door to a whole new tier of companies they previously had to turn away.
So they grew the market. But it's not just the size, it's the hassle factor. They mentioned tech-enabled renewals.
I'm sure every business owner listening just sat up a little straighter.
Oh, absolutely. Renewing a credit line is usually a nightmare of paperwork.
Total friction. They're using tech to allow for transaction-based renewals. They can see the cash flow in your account, so they can automate the decision.
That is a game changer. It tells the business owner, we trust you and we value your time.
It's how you build loyalty. Make it easy to do business with you.
They also talk about a dedicated vertical for MSME.
This is the organizational fix. In the old days, the branch manager was a generalist. He had to know about everything from savings accounts to complex business credit.
A master of none.
Pretty much. Now they have dedicated relationship managers just for MSME. So a factory owner is talking to someone who actually understands working capital, not someone who just helped reset a debit card PI.
Makes a huge difference. Now, what about geography? The name is South Indian Bank.
Home turf is Kerala for sure. 38% of the MSME book is there.
But another 38% is in the south, outside of Kerala. And a full 24%, almost a quarter, is in the rest of India.
And that rest of India slice is the one to watch. They are making a very conscious push to become a national player. They're using Kerala as a stable base, but hunting for growth everywhere else.
Okay, let's move on to my favorite slide in the whole deck. I've been waiting for this. Segment 4, efficiency, branch value added same-store sales.
I had a feeling you'd latch onto that one.
I mean, how can you not? Same-store sales is the holy grail for retail. It's how Starbucks measures its success. I almost never seen a bank use this terminology so proudly.
It's unusual, but it's brilliant. It forces you to look at efficiency in a way that traditional metrics just hide.
So what are they actually measuring?
They're treating each branch like a store. They're calculating the net present value of new products sold in existing accounts. They're basically asking, is this physical branch actually generating new value, or is it just a cost center?
They're hunting for zombie branches.
That's a great way to put it. A branch that just exists but doesn't grow.
Yeah.
By measuring this, they hold every single branch accountable.
And the numbers are, well, they're a hockey stick. If you take Q4 of FY24 as the baseline, call it 100%.
Right.
By this quarter, Q3 FY26, the index has hit 193%.
That is a stunning number. The productivity of their existing branch network has nearly doubled in less than 2 years.
In terms of value added, yes. So what's happening on the grounds? Are the staff just working twice as hard?
No, it's not that. It connects back to what they said. Significant improvement in processes and systems. It's digitization.
Oh.
When you digitize the boring stuff, you free up the humans. The teller isn't just counting cash behind glass anymore.
They're out in the lobby, selling products, originating business.
They've turned their staff from transaction processors into value creators. That's the aha moment. They're squeezing more juice from the orange they already have.
Which is the most sustainable way to grow. Okay, devil's advocate time. We've been celebrating this pivot, but 40% of the book is still corporate. That's a big chunk of change.
A fair point. And it brings us to the safety net. You have to look at the quality of that corporate book.
The slide says dominant share of A and above rated corporate loans.
And the number is incredible, 98.2%.
Wait, 98.2% of what?
Of their standard large corporate loans, so loans of 100 crore and above, practically all of it is lent to companies rated A or higher.
So the blue chips, the safest of the safe.
Exactly. They've adopted a barbell strategy.
A barbell.
Imagine a barbell. On one end, you have the high-growth, granular retail and MSME loans. On the other end, you have these super safe, low-risk, highly rated corporate loans. They're avoiding the risky middle ground.
That makes sense. What about the loans that have already gone bad, the NPAs?
The trend there is also good. The gross NPA ratio is at 4.32%, which is down from 4.74 last year.
And the net NPA, the number that really matters.
Down to 1.07%. Very manageable. And the real comfort comes from the provision coverage ratio, the PCR. It's at about 81%.
Can you translate PCR into plain English for us?
It's their rainy day fund for bad loans. An 81% PCR means for every 100 rupees of bad loans they have, they've already set aside 81 rupees to cover the loss.
So the shock absorber is already in place.
Exactly. The hit has largely been taken.
Reassuring. So let's close the loop on the retail side. What's in that personal segment bucket?
This is a great window into the Indian consumer in 2026. Housing loans are the big one, 31%, and mortgage loans are another 17%.
So almost half of their personal lending is tied to property.
Which is generally very secure. People pay their mortgage.
And I see gold loans at 24%.
Retail gold specifically. This is so core to the Indian market. Families use gold as savings. When they need quick cash, they pledge it.
The ultimate liquid asset.
Exactly. The fact that it's a quarter of their personal book shows they're deeply plugged into the financial habits of their customers.
And the growth is there too. Home loans up to 8,430 crore. Auto loans up to 2,393 crore.
It's financing the aspirations of the middle class. Homes, cars, gold.
You know, it really is a complete story. I came in this morning expecting a sleepy report from a regional bank. This feels urgent.
Urgent and deliberate. That's a rare combo. The urgency is coupled with a very clear roadmap.
So, to synthesize for everyone listening,
Right.
we have a bank, almost a century old, that's acting like a nimble fintech.
Right.
They're tracking same-store sales,
Yeah.
using tech to remove friction, and pivoting hard to smaller, safer loans.
And the key takeaway is the balance. They're balancing that aggressive growth in retail with a super safe 98% A-rated corporate book. It's growth on one side, safety on the other.
And the result is a nearly 14% ROE and climbing efficiency.
It's a case study in how a legacy institution can reinvent itself. They changed the plumbing, not just the logo.
Before we go, I want to leave you with one final thought. I can't get that same-store sales metric out of my head.
It's the standout metric for me, too.
Here's the question. If every bank in the world had to report branch value added with this kind of transparency, what would we find?
Ooh, that is a dangerous question for a lot of banks.
Right. How many bank branches are actually zombies, just coasting? South Indian Bank is proving they doubled productivity just by tracking it. Should we demand this from all banks?
It raises the bar. In a digital world, a physical branch has to justify its existence. If you aren't measuring its value, you're flying blind. And they've taken off the blindfold.
It's a fascinating thought. If you invest in other banks, maybe check their next presentation. Do they tell you how productive their branches are or just how many they have?
Quality over quantity.
Indeed. Look for that next-gen banking in your own financial life. We'll be back soon with another deep dive. Until then, stay curious.